Good evening, VV Nation. Ron Wheeler here, manager of options trading for VectorVest, and it's my pleasure to bring you tonight's special presentation, Beating Inflation, a Smarter Alternative Beyond Fixed Income Investments. Well, let's talk first about fixed income investments. What are they? Well, a fixed income investment is generally going to be your safest investment strategy. It's a CD, it's a bond fund, something that you can put your money in without any worry and create some opportunity for income. Now, let's take a look at some of these. First and foremost, I simply went to bankrate.com. I typed in, I want to look at a $100,000 deposit, and that 44333 happens to be the zip code of our Akron office here at VectorVest. And what did I find? Lo and behold, some 1 year and even a 6-month term for a CD at 5.5%. So, hey, I could put 100 grand into a CD. I'll make about $5,500 a year on my investment. Not bad, right? 5.5%. You don't have to risk anything. Very simple. Well, what about some bond funds? What about some fixed income funds? So again, using the power of Google, I went out there and typed in fixed income investments, and I found some great returns. Now, yearly, some of these are doing really well. The floating rate fund, that's 8.9% as of 10/19, the year-to-date return. That's not a bad return. Again, 100 grand in there. You have some risk. There could be drawdown. It's not as good as a CD, but you are seeing some of these high-yield funds at 6%, Global High Income Bond Fund at 5%. These are safer, more sound investments, and they are good investments, and they should be part of most likely everybody's investment profile. But how good of an investment are they really when you factor in inflation? Because unfortunately, one of the products of a high interest rate time is also high inflation. So I'm going to open up a graph here in VectorVest, and we're going to do some comparisons. First off, on the top, you're going to see the CPI. CPI, fortunately, is down from that high of 8%, but it's still hovering around 4%. And I think that we can make the case that while CPI is at 4%, does it really measure everything that's increased in prices over the last few years? I think prices have increased a lot more than 4%. But let's just take the CPI for what it is. Now, go down a column into the orange line. You've got your T-bills returning a little over 5%. Awesome. Problem is, you have to have that hurdle. You're making 5% in your T-bills. You're losing 4% in inflation. What's your actual return? 1%? T-notes at a little over 4.5%. Again, you're barely beating out the CPI. You're getting a 0.5% return. AAA corporate bonds, right around 6%. A little bit better, right? Inflation at 4%, you're getting a 2% rate of return. So while fixed income is a good part of a overall portfolio, it's not going to bring you the returns that you expect once you bring inflation into the picture. And that brings me back to the theme of tonight's presentation, which our goal here at VectorVest is to help you not only beat inflation, but simultaneously beat the returns of these fixed income investments. And most importantly, we want to be as safe as we can. We don't want you taking high risk opportunities. And how are we going to do that? Well, the first way we're going to do it is we're going to be very, very selective in our trading and in our investing approach. We're going to do something that I like to call layering probability. Now, think of this. You see a cake here. Cakes have all kinds of different layers, right? We're going to use the same approach to our investment strategy to create a system that has a great rate of return, but puts as much safety on your side as we can. So I'm going to give you a few steps and walk you through some guides to how to do this. Now, the first thing that we want to do is very, very simple. We want to trade in the direction of the market. That simply means using one of our trading timing signals, such as the DEW. It's one of my favorites I like to do. When the market is in a DEW down, like it has been since August 11th, we are going to trade in the bearish direction only. Now, I know what some of you might say, well, Ron, I have an IRA, maybe I can't sell short. There are investment vehicles out there for you that can allow you to do this. You don't have to necessarily sell short to take advantage of a downward trend. When the DEW is up, we can reverse and we can start doing bullish trades, but we need to follow the direction of the market. This is going to put probability on your side. Now, the second thing that we're going to do is we are going to match the stock to the market direction. So when the market is in a downtrend like it is now with the DEW down, we are going to select stocks like Estee Lauder, for example. This is a trade that I've done quite a few trades on Estee Lauder here over the past 6 weeks. The stock has been trending down. The market is trending down. This stock has been moving lower over 1-year periods and over 3-month periods. This is the type of stock that I want to take advantage of. I don't want something that's been rallying all year. I want to stack probability by matching the market direction and stock direction together. Now, the third thing we're going to do, we're going to only trade stocks that are moving up or down for the day based on the market direction. So, bringing it all back to the first rule. Market direction, we're in a DEW down. Stocks that are moving down, such as we saw with Estee Lauder. Now, here's what we're going to do. I'm going to flip over to VectorVest and I'm going to show you a really simple filter that you can use to help you do this. So I've moved ourselves over to the Unisearch in VectorVest. I'm going to do a scan for, I'll just do Doug's Down or Supercharge. It doesn't really make a difference which scan you choose. Just choose one I happen to be in the Searches Short folder. I'm going to go ahead and run that search. Oops, I got to click on it first. Go ahead and run that search. And I get a list of stocks that are mostly down, but look at this. Some of them are up. All of these stocks are up for the day. I want to filter this down to only stocks that are moving down. Market down, stock down. So I'm going to go to my parameters. I'm going to go to parameter. I'm going to choose stocks, price, price actual. I want that to be less than. Then I'm going to go to value. I'm going to choose custom date and value. Under date, I'll choose days, 1 day ago, and under value, stocks, price, and we're going to choose the low. So essentially what we're looking for now is stocks that are making lower lows day over day. Now if I rerun that search, you'll notice that in my percentage change and my change, these stocks are all red. If I graph those, take a look at Zim Integrated, and I'm just going to zoom into the last 3 months, you're going to notice that looking at today's bar, we are moving lower. It has a lower high and a lower low. Scrolling down to another example, same thing with Leafly Holdings, same thing with Arus, Arvinas, and I'm probably pronouncing some of these names wrong, but that's okay. You get the idea of it. These stocks are moving lower day over day, and that's what I want to see. Do down, stocks moving down day over day. So I'm funneling all of this into the direction of the market. Now the next layer, this one's going to require a little bit of work. We are going to become an option trader and more importantly, an option seller. And we are going to sell options that have a greater than 60% chance of winning. So let me kind of explain how this works a little bit. On a typical trade, you have a 50-50 chance of being successful, right? Because you have what's called a buyer's mentality. If you think a stock will go up or go down, it doesn't matter what direction, you have a 50-50 chance of making money. Because the only way you can make money is if the stock goes in your direction. If it goes sideways, you break even. If it goes down in a bullish trade, you lose. If it goes up in a bearish trade, you lose. Okay? What we're going to use is probability from the option itself. Every option has a built-in probability. And we're going to choose an option that has a base 60% chance of winning. So in this case, take a look at, this happens to be a trade of the S&P 500 back from 2020, and I'll show you a more current example, of course. The S&P was trading at 33.97. I choose a price down at 33.60, and as long as the price stays above that, we can be profitable. What that means is my market can go up, sideways, or down, and I can still make money. I'm adding probability because I'm giving myself more room to be profitable. Okay? This is what I refer to as an income trade. Fixed income, income. These trades are called income trades because we're layering probability on them. We're not just going out and randomly selling short a stock. We're following a plan. An income trade is simply one that can be defined by you can make money even if you're wrong on direction. Kind of like putting your money into a CD, right? Doesn't matter what the market does when you've locked in a 5.5% rate on a CD. We're using options opportunities to create these income type approaches. Now, I'd like to give you an example of how this works. So let's take a look at a stock. This happens to be Apple. Apple is down. And just to be clear, I'm not saying Apple is the correct trade for this. I just want to use this as an example. So if I think Apple will continue down, right now it's trading at 173.96. If I just went out there and sold 1,000 shares on Apple, as long as Apple goes down, I can make money. Now, an option trader might go out and say, all right, I'm going to buy a put. So let's open up a risk graph on Apple and let's simulate what would happen if we bought a put. Now, here's the problem when you go out there and buy a put. And it doesn't really matter when you buy it, what expiration. So let's just choose a December. We'll do a 175. We'll even do a 180. We'll go a little bit more in the money. Now, I want you to take a look at this risk graph. Number one, this is where the stock is at currently at 173. By the time this option gets to expiration, look what happens. You have to be below 170 to actually make money. Unless this stock gets below 170, you are not going to see any real significant gains because being an option buyer really is putting probability not on your side. So what we're going to do is we're going to flip the script a little bit. We're going to use probability and create an income trade. Now, what is probability? Very quickly, probability, and I can open up an option chain, and it doesn't have to be in our Options Pro software. But if I look at our Options Pro, there's a column that says ITM. It stands for in the money, and it gives you a percentage. So if I look at Apple, and I go to my November option, and I take a look at the 180 strike price, this tells me that we have a 25% chance of that option being in the money by the date of expiration. So if I went out there and I sold a 180 call, the enemy of my trade is if that option goes in the money. I am going to sell an out of the money option with the idea that it will stay out of the money. Now, if I take this back to a graph, I chose an option, or I would choose an option at 180. That means I'm selling an option up here. Now, Apple can go down, like I think or hope it would, and I can be profitable. If Apple goes sideways, I can be profitable. If Apple goes up but stays below 180, I can still be profitable. But what happens if Apple passes 180? Then I'm going to take a small proportional loss on my trade. Now, I also just happened to add a screen capture from Thinkorswim. This is the Thinkorswim trading platform, and every platform is very similar. IB, E-Trade, Fidelity, they all have calculators of probability. So I just happen to have the December option open, and you can see that even Thinkorswim has a Prob ITM calculator and a column that'll tell you what the probability of the option is. Well, here in December, that same 180 has a 34% chance of staying below 180. I'm going out an extra month in this instance. Okay, so what we're going to do is we are going to construct our options trades with a base 60% chance of success. Now, we're not doing the option trade in a vacuum. Remember, we're layering probability, market direction, stock moving in the direction of the market, 60% option. We're layering probability to give ourselves the best chance of success. Now, one of the last things I want to talk about in tonight's presentation is avoiding large risk. That's the whole purpose. You go into a fixed income investment because you want to avoid large risk. And we want to do the same. One of the horror stories that I hear about, well, Ron, I've tried selling options before, and I heard a friend of mine doing this, and he had 30 winning trades, and he had 80% or 85% winners. And then one trade came in, and it blew out all of his gains. Is that something that can occur? The answer is yes, it can. But it's really, really easy to avoid. And I'm going to bring this girl back. How do we avoid it? We are going to be selective. One of the beauties of being an option seller is that risk is known up front. Before we even place the trade, we know what our risk is going to be. So let me walk you through an example. And I want to show you some of the technology we have here at VectorVest for this. This happens again to be my Options Pro software. I'm going to show you a graph of a stock. So we'll use Alta as an example. Alta's been in a nice downtrend here for the past really 7-8 months. It's down today, only 10 cents, but it is down for the day. Now what we're going to do is we're going to create a trading opportunity, and we're going to do something called a bear call spread. What we're going to do is we are going to focus on selling an option that gives us a 60% or better chance of success. Now, one of the great tools we have here at VectorVest is Options Pro, and I want to show you a really great tool this. There's something called the spread select. Now, what I'm going to do with this is I'm going to choose Alta in the upper left-hand corner. Since I already looked at Alta, that's the graph that comes up, or the choice that comes up. Under spread type, I'm going to choose bear call spread. I'm going to choose November 17th. Generally speaking, I like 21 to 45 days of expiration. I want to do this above the current price of the stock. So ultimately, no pun intended with Alta, what I want to do is I want to select a call that is above the current price. I think that Alta might continue to go down, so I want to select something above the price that says if I put a position here, as long as Alta stays below, let's say 385, I can make money. So we're going to say above the current price. Now I'm going to go on to my filters, and this is what makes this really easy. In my filters, I have a long leg. When I do a bear call spread, there's a long option, an option that I buy as insurance. And I'll explain why I do that here in just a few seconds. And there's an option that I sell. Now, the option that I sell, I want to make sure that it doesn't have a probability above 40%. Okay? I don't want it to be above 40%. And I'll explain how that works here in just a second too. I also like to make sure it's got a little bit of liquidity using open interest. So I say 100. For my insurance leg, all I really care about is if it has open interest of 100. Now here's the best part. I want to only have trades that are identified with a risk to reward of better than 3 to 1. I click OK. I tell it to use the spread filters. Now, over on the right, I'm going to get a pass or a fail. Now, this is not enough trades for me to see. I want this thing to analyze a lot of positions. So there's a number of strikes column. I simply click on that, and it expands the trade. And you can see that I actually have 4 passing trading opportunities that work for Alta. Now, what I typically like to do is I go through these passing trades and I look at the option that I'm selling. 380, 380, 385, 385, 390, 390. Now, the higher the price of the option that you're selling, the better probability you're going to get. So, if I take a look, this trade has a 36% chance of failure. That means it has a 64% chance of winning. The next trade, same thing, 36%. 30%, 30% chance of losing because there's a 30% chance that Alta will go above 385 in the next 28 days. So, if that's the trade that I like, and I can even go down a little bit further, 30%, 23%. Now, I'm going to show you this trade down here that's got the lowest probability of 23%. Now, that means that we would have a statistical 77% chance of making money. If I right-click on that trade and I go into a risk graph, this is what the trade would look like. Now, this is how a bear call spread works. I hope that the market will go down. As the market goes down, you're going to see the trade, how it enters into this green section. This is where I would make money. If the trade goes up in price, I get into the red, and this is where I would lose money. Now, I'll give you a very simple strategy for this. Over on the right, this trade has a $150 maximum profit. That means if I let this trade go all the way to expiration, which I never do, I can make $150. The worst that I could do is lose $350. Okay? Now, remember what I set up in that filter. 350 divided by 150 is a risk reward of 2.33 to 1. That's very, very good. Now, the way that we manage these trades is very simple. You are going to take profits at 50% of the credit you took. $75 is my profit objective on this trade. Why? Here's why. I want you to follow this dashed line. Where does this trade have to go to hit $75 in profits? Roughly down to $355. Where would it have to go to get all the profits? All the way down to like $330 a share. You're going to make more money by taking profits at 50%, and if the stock continues to go down, entering into a second trade. Okay? Now, that $355 risk is pretty intense, but I want you again, follow the dashed line. Where would that $350 loss be obtained? The stock would have to go all the way up to $460 plus a share. That's not what we're going to do. We're going to use a stop no different than if we would have sold the stock. Since I'm choosing that $390 call, if Alta rises above 390, so right now it's trading at 373. If Alta goes up to $390 a share, I will exit this trade. If you follow, and I'm going to turn my crosshair on, if you follow all the way down to 390, this trade has a loss of about $94. It has a $75 gain, and it has a $94 potential loss. That's not too bad. Now, if you think about the graph of Alta, that price was $390. That's right up here. That means I think that Alta can go down, but as long as it stays below this number right here, I have a chance of success. If it goes beyond that, I would take a loss. Now, I want you to put that into context here. Okay? With those numbers that I talked about. A $150 max gain gives me a $75 potential profit, and a $94 potential loss. Now, a lot of people look at that and say, Ron, why would you ever want to lose more than you gain? Normally you don't, but in a trade like this, it's acceptable because you are picking up, and I'm just going to round the number here, a 75% likelihood of success. Think about that. Let's do the math on that. And this is why it works. So let's say you place 100 trades per year with a 75% probability. Well, that's about 8.3 trades per month. Not a lot of work. You can, of course, adjust this up, adjust this down. I have clients who take 300 trades a year. I have people like me who generally average about 100 stock trades a year. So let's say you have an average win, just like we showed you, of $75 per contract. You have an average loss of $94. That means you're going to have 75 winners of 75 bucks. You're going to make $5,625. You're going to have 25 losers at $94 or a loss of $23.50. That's going to give you an overall gain of $32.75. You're going to make a lot more money doing this type of approach. Now, you might ask, well, how much money would I have to put up to do that trade? Well, if I took that trade on one contract, and I'll go back to the risk graph, if I took that trade on one contract, it's going to cost me $350 in margin typically. Now, let me kind of explain how this works in a much larger account. What I would generally tell somebody is don't take any risk more than 2% of your capital. I like to be very conservative. And that's what we're going for here, right? Conservative. So I would tell you don't risk more than about 1.2% of your capital. That means, let's say this trade, we have a $94 risk. Let's say you have a $50,000 capital account. I would say don't risk any more than 1.2% of your account. That's going to give you about a $600 risk on this trade. So what we're going to do is we're going to trade enough contracts to get you to about a $600 risk. 6 contracts. My risk on this trade goes to about $631. Okay. And now my profit was $780. Now it's going to be about $390. My max profit, I should say, was $780. The market's moving in real time right here, so you have to keep that in mind. But when I first looked at it, it was about $780. That's going to give me a $390 profit. Okay? So if you do those types of numbers, let's do the math again. So let's run those numbers. Again, same idea, 100 trades per year with that 75% probability. Now, keep in mind, 75% probability is more than you're going to get on some trades. You're going to go as low as 60, but in this particular instance, it was 75. But what I want you to do is when you identify a trade, I want you to run numbers just like this to make sure your rate of return is good. So 8.3 trades per month. Your average gain in this instance was 380. Your average loss goes to 630. And again, if you look at those numbers, you're going to be afraid. However, you're putting probability on your side because remember, you got a lot of room for this thing to be wrong. So on 75 winning trades, that's 29,250. On the 25 losers, you're losing 15,775. Your overall gain is going to be 13,475, or based on a $50,000 account, about 26% ROI. That is what beats inflation. That is what kills the return on a fixed income device. And these trades are built with probability. And it's all about stacking probability in your favor. Okay? In some trades, you can do the math and get a 75%. However, if you run these numbers and the trade only had a 60% probability, this would not work. So you have to do the math. You have to keep the trade safe. Combine the minimum 60% probability of winning. Keep the risk reward in line. Extrapolate the data like we just did. If you can follow that, you can beat inflation and fixed income returns. The goal here is to keep it the same. We don't want to deviate from this plan. Do not deviate. Market direction. Trade in the direction of the trend. Match the stock to the market. Only trade stocks that are moving in the direction that you want to go that day. And keep the risk low. This is the hallmark of building safe, repeatable returns. Now, if this is something you're interested in doing, we are launching our well-received Options Paycheck Experience course, launching for November and December. Grab your seat. This is the most comprehensive program that you will find to generate that type of income using option spreads. And even if you've never traded options before, this is a one-of-a-kind program. We are going to teach you from the ground floor how to properly generate income from options trading. We're going to show you how to find these trades like Alta, manage that risk reward like we showed you, and make sure that you are generating income in the safest way possible. The way the course breaks down, it's an 8-module course. We teach the course in November. We take you through all 8 modules of option basics to creating these spreads I showed you, how to do it, finding market direction properly, finding the right stocks, setting these trades up perfectly in modules 5 and module 6. You're going to know exactly what option to sell. You're going to know exactly how to buy the right insurance, what risk reward profile to look at. Module 7, we're going to teach you the trade management so you know where to take profits, know how to set your stops, know how to allocate your portfolio properly. In module 8, we even talk about the execution phase with your broker. We put everything we do into a nice, easy to use checklist. That way, if you're just starting out, you've got something that you can work from, because remember, we want to keep everything the same. Follow the rules every single trade. This is how you can trade with the least amount of risk. For those of you that have never done this in a broker, we even have some broker videos and some broker documents that'll help you place these trades, in addition to the broker support that you'll get from each individual company. This will help you be confident to place these trades when you learn the system. Now, we also offer a 100% money back guarantee. Take the course, do the work, take the classes, watch the videos. If you're not satisfied, you can notify us within a week of the end of the course and you can get your money back. Our goal is to help you generate 3% per month. It doesn't have to be 3% per month. If you want to be more passive and take less trades, 1 or 2% per month with a few trades a month. That's still going to beat inflation, beat those 5 or 6% interest rates. This is going to help you do it. Now, to make sure that you're understanding the material, we got a couple of bonuses we throw in. In November, while you are learning the curriculum, we're going to give you weekly mastery sessions for each module. This is where we can get together live. We can talk about the module, answer any questions you have. We have a weekly wrap-up question and answer session. We have a private dedicated email that you can send us email messages to. We're also going to give you, if you don't already have it, VectorVest and Options Pro. You're going to get that for November and December while the course is running. It lets you experience the software I just showed you. Is that software mandatory? The answer is no. It is a nice tool for speed and efficiency, however. We're going to let you test drive that through November and December. The biggest bonus, however, in my opinion, is December, and that's our implementation month. You're going to be invited to my live trading sessions. We're going to actually show you how to implement this using my account, My Live Money. I will show you how I place these trades. We'll have follow-up office hours sessions later in the week. You're going to get a total of 12 total sessions. These are all recorded. If you can't make our live sessions, you can always watch the recording. Lastly, the SPX Paycheck System. This is going to allow you to condense everything we teach you down to one position, the S&P 500 index. You can do one trade a week on one ticker symbol. It's a very quick and easy to use system. And again, you'll get live trading sessions for that. So just a quick recap, if you're interested in the Options Paycheck, you get the 8 training modules, the videos, the cheat sheets, the live classes of the mastery session, the implementation month, also the SPX Paycheck System. That's a total value of $54.75. However, I've got a special deal for you. If you order before Monday at 6 p.m. Eastern Time, you can get our special Buy It Now bonus for $9.95. Just go to optionspaycheck.com, get yourself registered. Close out 2023 by learning a safe, secure income system for 2024. So with that, I want to thank you for watching tonight's presentation, and I hope I opened your eyes to a new way of generating income that can exceed a normal fixed income investment. Thanks for watching, everybody. Hope to see you in November and December in our Options Paycheck experience. Good night, everyone.